Hello everyone. See, one more small chapter in this financial management is left over. That is fund flow statement. Chapter number 4. That is fund flow statement. So before that, we have finished all the financial management. We have covered all the chapters. Only the small chapter, that is fund flow statement, is left over. Fund flow statement is also a very easy chapter, just like cash flow statement. How funds has been rotated in the business, that is seen in this fund flow statement. So basically, what is this fund flow statement? Is fund flow statement, it is widely used tool in the financial performance, like in the hands of financial executives for analyzing the financial performance. So this fund flow statement, that is FFS, we call it FFS, but fund flow statement, it analyzes the financial performance of the business concerned. Basically, funds keeps moving in the business. Suppose, see how funds keep moving in the business. You will purchase asset, you will sell asset, you will increase your working capital, or there will be some profits. So profit is nothing but fund flow. There is incoming of cash or incoming of fund. So this fund keeps moving in the business. So this movement of funds in the business is analyzed in the fund flow statement. And this fund flow statement gives detailed analysis of changes in distribution of resources. That is, suppose you have put in capital of 20 lakhs, how this 20 lakh rupees, that is how this 20 lakh value of funds keeps moving in the business, that is analyzed in this fund flow statement. And it describes the in a particular balance sheet. That suppose from 30th March 2016 to 30th March 2017, between two balance sheets, how a funds has been rotated, how much increase in, that is sources of fund. There are two types of things, that is source of funds, application of funds. Source of funds is nothing but where a fund is coming in, that is called source of fund. Application of fund, where you are using those funds, that is application of fund. So the changes in the source of fund and application of fund, basically the addition of funds and removal of funds is recorded in this fund flow statement. So as I told, there are two types of things, that is source of funds and application of funds. Source of funds is nothing but where your funds are coming in. For example, issue of share capital. When you are issuing share capital, cash is coming in or fund is coming in. You should not only take cash. You should see all the assets, liabilities, working capital, and also funds from operation, that is net profits. All these should be considered in the fund flow statement. So basically, what are the different source of funds? Issue of share capital, funds from operation. Funds from operation is nothing but net profits. What is the profit you are making from the business operations? That is funds from operations. Third one is issue of debentures of long-term loans. By issue of debentures, you will get some funds. Sale of fixed deposits or long-term investment. When you are selling a long-term investments, there is some funds coming in. Non-trading income. So when there is non-trading income, that is also nothing but source of fund. A fund has been coming in. Decrease in working capital. Understand it. See, when there is decrease in working capital, that is from previous balance sheet year to previous balance sheet to current balance sheet, when there is decrease in working capital, you are taking out some cash. That is, you are taking back some funds from the working capital. And when you are taking back, there is some fund coming into the business. See, suppose you have put in debtors for a login period of 3 months, 3 lakh rupees. Subsequently, in the next balance sheet year, you have reduced your debtors. That is, from 3 lakh to 1 lakh rupees you have reduced. So remaining 2 lakh is coming into the business again. That is which has been put in working capital, which has taken back and coming into the business. So that is nothing but source of funds. And on the other side, when there is increase in working capital, then you are putting cash in working capital. That time cash is going and getting logged in. That is, you are putting your cash. So application of funds. So basically, source of funds are these kinds of different ones, and any other increase in liability and decrease in asset. See, when there is decrease in asset, sales value of suppose land and building previous year is 10 lakhs, current year 5 lakhs. There is decrease in asset, which means there is sale of land and building. So the sale of land and building is nothing but source of funds. When you are selling your land and building, you are getting some fund which is coming into the business. So source of fund. Application of fund is nothing but purchase of land and building. You are putting your fund, you are giving your fund and purchasing land and building. So that is called application of funds. So these are the examples of application of funds. Redemption of preference share capital. When you are redeeming, you are paying back your funds. Redemption of debentures, repayment of long-term loans, purchase of fixed assets, payment of dividend and tax, any other non-trading payment, funds lost through business operation. That is, when there is net loss, simple man, this funds from business operation account is nothing but profit and loss appropriation account. How you will do profit and loss appropriation account? Same thing you should do in this fund from operation account. When there is profit, you will put in source of funds. When there is loss, you will put in application of funds. So that is a source of funds and application of funds. See, I'll explain you the procedure of fund flow statement in very easy way, so that if I solve one problem also, the remaining all problems you can solve on your own. Very simple. First, you should always calculate what is the changes in net working capital. That is working capital management sums we did know. The same method you should apply it here. You should see where and all current assets has been increased, where and all current assets has been decreased. All those things you should record. Then you should find what is the changes in working capital. Simple. How to analyze the changes in working capital is, for previous year balance sheet, calculate what is the working capital. For current year balance sheet, calculate what is working capital. How will you calculate working capital? Current assets minus current liabilities. So you will get what is the working capital for both years. So compared to the previous year, if there is increase in working capital, take it to the application of funds. When there is decrease in working capital, you are taking back your funds, so it is going to sources of funds. That is procedure 1. Second step is analyze all the non-current assets and non-current liabilities. That is all land and building, plant and machinery. On the asset side, what are all the different non-current assets, and on liability side, what are all different non-current liabilities. Analyze all the non-current assets and non-current liabilities and find whether there is source of fund or application of fund. That is step number 2. And step number 3 is calculation of fund from operation. Funds from operation is nothing but the profit generated from the activities during the period, or the surplus generated from the activities during the period. Simple. Profit and loss appropriation account. Opening balance will be on the credit side, closing balance will be on the debit side. So you should compare the fund flow statement and find how much is the profit made during the year or loss made during the year. So accordingly, any profit surplus from the fund from operation will go to source of funds. Any loss will go to the application of funds. That is third step. And the last step is summarizing source of funds and application of funds. On the assets, on the liability side, source of funds, where and all cash is coming in. On the asset side, application of funds, where and all you are investing your cash, investing your funds. So in the end, the source of funds and application of funds should tally. That's all. That is fund from operation. Fund flow statement. If you do the problem number 1, you will find it very easy to solve all the other problems. So now we got some clarity. That is what is fund flow statement. See, first fund flow statement. This is the primary statement. That is format of fund flow statement. On the asset side, source of funds. On the liability side, application of funds. So all the source of funds will come this side, application of funds will come this side. In the end, the amount should tally. So working notes. Different working notes are calculation of funds from operation. Funds from operation is nothing but profit and loss adjustment account. So opening balance, and you should find what is the funds from operation. Closing balance is nothing but funds from operation. If it is on the asset, if it is on the debit side, it will go to the source of funds. If it is on the credit side, it will go to the application of funds from operation. And the next one is changes in working capital. Just calculate what is the last year working capital and the current year working capital by analyzing current assets minus current liabilities. You will get what is net working capital. If suppose last year is 1 lakh and this year is 2 lakh, then there is 1 lakh increase in working capital. So that's all. These 3 statements you should give. Simple. All the numbers will be given in the question. You don't have to find any new numbers. You should take that all the numbers and put it in the format, so that you will get what is the fund flow statement. That is, it will tally. Fund flow statement, source of funds and application of funds will tally. So come to the solution. Sorry, come to the problems. We'll start off with problem number 1. From the following balance sheet of Xerox Limited. So there is a Xerox Limited. They have a balance sheet. For that, fund flow statement should be prepared. So below that, first they have, see, liability side, what and all they have given: equity share capital, redemption, redeemable preference share capital reserve, general reserve, P&L account, proposed dividends, sundry creditors, bills payable, liabilities for expenses, provision for tax. So these are the different liabilities, and assets are goodwill, land and building, plant and machinery, investments, sundry debtors, stock, bills receivable, cash in hand, cash at bank, preliminary expenses. So these are all different assets. So we have found what is the liabilities and what is assets. So additional information. A part of land was sold out in 2016. So point number A, part of land was sold out in 2016 and the profit was credited to capital reserve. Okay. When there is, see here there is fall in land and building. So that land and building fall is 15,000. So that 15,000 land has been sold at a profit of 10,000. That is capital reserve. Whatever the profit on land and building sales, that has been credited to capital reserve. So 15,000 plus 10,000, 25,000 is the sale value of land and building. That is how you should calculate what is the sale value. So next is a machine has been sold for rupees 5,000. Written down value of machinery is 6,000. Depreciation of 5,000 was charged on the plant in 2016. Simple. 40,000 is the beginning of the year. Okay, on that 40,000, written down value of the machinery is 6,000. So 6,000 you should reduce it. How much you are getting? 34,000. And upon that, sorry, 4,000, 40,000 minus 5,000, 35,000. Upon that, we should actually, what we should do for this point number B is we should create a separate account called machinery account and record all the transactions and find what is the value of plant and machinery that has been purchased, because previous year ending, that is at the beginning of the year, it is only 40, end of the year 100. There is some purchase of plant and machinery, so that we should calculate the amount. Point number C, an interim dividend of 10,000 has been paid in 2016. There is payment of dividend, which is nothing but application of funds. So you should directly take it to the application of funds, payment of dividend. See, they have paid interim dividend of 10,000. And also there is some proposed dividend which has been proposed for the year beginning, that is previous year ending 21. So 21 should be paid in the current year. So 21,000 plus 10,000 interim dividend, that is 31,000. Total payment of dividend is 31,000. So in the application of funds column, payment of dividend 31,000. So when we are doing solving this problem, you will find how to calculate what are different items. An amount of 1,000 has been received as dividend on investment in 2016. So receiving dividend, that is nothing but source of funds. So in the source of funds, simply record a dividend received on investment 1,000 rupees. That is how we should calculate this problem number 1. So you are required to prepare fund flow statement. So moving on to the solution, this is one simple concept. Fund flow statement is nothing but taking the numbers from the question and putting it in the right places. That's all. You don't have to find any new calculations. Take the numbers from this question, all full question, you should utilize it and find the fund flow statement. That too, you are not going to find any number. Fund flow statement, you should tally it like balance sheet. That's all. Come to the solution. Chapter number 4. Fund flow statement. Fund flow statement. Below that, problem number 1. Fund flow statement of statement number 1. Record. Fund flow statement of Xerox Limited. For year ended 31st March 2016. For the year ended 31st March 2016. So fund flow statement of Xerox Limited for the year ended 31st March 2016. Below that, 2 columnar table. First column, sources of funds. Second column, application of funds. First column, sources of funds. Second column, application of funds. See this. Actually divide the page into 2 parts. On the left hand side, sources of funds and amount. Right hand side, application of funds and amount. Sources of funds is nothing but where your cash has been coming in, from where your cash is coming in or your funds are coming in. And application of funds is nothing but where your funds are going out, like where you are using your funds. So that is called source of funds and application of funds. This fund flow statement, this is the primary statement for this fund flow statement, and remaining are working notes. So sources of funds amount and application of funds amount. Below that, leave 10 to 15 lines, 10 lines gap. Enough. Leave 10 lines gap. Below that, working notes. Record working notes. Below that, working note number 1. Statement showing changes in working capital. Statement showing changes in working capital. So below that, record three columnar table. First column particulars. Second column 2014-15. For second column, what is the year? 2014-15. Third column 15-16. 14-15 and 15-16. So what is the format for the working capital? For calculation of working capital, current assets minus current liabilities. Below that, capital A, current assets. Below that, particulars, capital A, current assets. Record one by one. Below that, what are the different current assets? Investments, here we are considering it as long-term investments. So we are going from sundry debtors as current assets. So below that sundry debtors, copy the amount 70,000, 85,000, 70,000 in respect of 14, 15, and last column 85,000, 15, 16, 85,000. Below that stock 14, 15, 39,000, and 15, 16, 55,000, 15, 16, 55,000. Below that bills receivable 14, 15, 10,000, 14, 15, 10,000, 15, 16, 15,000, 15, 16, 15,000. Below that cash in hand 14, 15, 7,000, 14, 15, 7,000, 15, 16, 5,000, 15, 16, 5,000. Below that cash at bank 14, 15, 5,000, 14, 15, 5,000, and 15, 16, 4,000. So these are the different current assets. Preliminary expenses which is not considered in current assets. So next is total it. Now total it. Current assets total it. 70,000 plus 39,000 plus 10,000 plus 7,000 plus 5,000. You are getting 1,31,000. Below that underline it 1,31,000. And total the 15-16 column. 2015-16 how much? 85,000 plus 55,000 plus 15,000 plus 5,000 plus 4,000. You are getting below that underline it 1,64,000. So that is the total current assets 1,64,000. For 2014-15 1,31,000, 2015-16 1,64,000. So below that capital B current liabilities. What are the given current liabilities given here? Up to profit and loss account it is, see, sundry creditors is the current liabilities here. So record below that current liabilities record creditors. How much is for 14-15? 13,000. In respect of 2014-15 record 13,000, and 15-16 record 24,000. Below that bills payable 14-15 record 10,000, 15-16 record 8,000. 15-16 record 8,000. Below that liability for expenses. This is also a current liability. So in respect of 14-15 column 15,000, 15-16 column 18,000, 15-16 column 18,000. Below that provision for tax 14-15 column 20,000, and 15-16 column 25,000. 20,000 and 25,000. Now sundry current liabilities 2014-15 total it. 2014-15 total it. How much you are getting? 13,000 plus 10,000 plus 15,000 plus 20,000. You are getting 58,000. So below that underline it, record 58,000. Now total the 2015-16 column 24,000 plus 8,000 plus 18,000 plus 25,000. You are getting 75,000. So in respect of 15-16 column total it 75,000. Now just calculate what is working capital. Below that small c, capital C. Now total it 55,000 and 58,000 and 75,000 are the total current liabilities. Below that capital C, net working capital within bracket capital A minus capital B. Done. So what is capital A for 2014-15? 1,31,000. Capital B 58,000. So total it 1,31,000 minus 58,000. You are getting 73,000. So in respect of net working capital for 2014-15 record 73,000. So net working capital is nothing but current assets minus current liabilities. We have did so many sums in the working capital management related to this. So this table you can do it on your own for any kind of sum. If they are asking fund flow statement, first thing you should calculate is changes in working capital. So for 2014-15 is 73,000, and 2015-16 how much? 1,64,000 minus 75,000. You are getting 89,000. You are getting 89,000. Yeah. Respect of net working capital for 2015-16 record 89,000. 89,000. Done. With that we have calculated what is net working capital for 14-15 and 15-16. Now below that itself, below that C itself, record a note kind of thing. Increase in working capital is equal to increase in working capital within bracket. How much is the closing 15-16? That is for 2015-16 how much it is? 89,000. Then 14-15 73,000. So deduct it. 89,000 minus 73,000 is equal to 16,000. Is equal to 16,000. 16,000. Increase in working capital 89,000 minus 73,000 is equal to 16,000. So we have calculated what is increase in working capital. So when there is increase in working capital, what we should do? First understand it. If there is increase in working capital, extra fund has been given for working capital. That is, for working capital operations, you have put in extra amount. So you are using your funds. So it is nothing but application of funds. So when there is increase in working capital, take it to the application of funds. So come to the primary statement, that is fund flow statement. Below that application of funds record increase in working capital. Increase in working capital within bracket working note number 1. Increase in working capital within bracket working note number 1. Amount column record 16,000. Amount column record 16,000. 16,000. So next is moving on to the next working note. Come to the working notes. Below that record. See here. First we calculated what is increase or decrease in working capital. Second, what is the additional information they have given? Land and building. So we should calculate the separate account. We should open the land and building account so that we can find what is the profit or what is the sale value of land and building, or if there is any purchase of land and building. So below that working note number 2, land and building account. Open land, put the heading land and building account, divide the page into 2 parts. Debit side, left hand side debit and right hand side credit. Left hand side debit and right hand side credit. Debit side record particular amount and credit side also record particular amount. Debit side and credit side also particular amount. See, land and building is an asset. So opening balance will come on the debit side, closing balance will come on the credit side. So previous year closing balance is nothing but opening balance for the current year. So record on the debit side 2 balance brought down. How much is the opening balance? 100 into 1000. So that is nothing but 1 lakh. See, we are not doing it in the smaller unit. We are just calculating in the lakhs itself. That is 100 into 1000. You are getting 1 lakh. So record 1 lakh itself. Converted into lakhs. So 1 lakh opening balance. 2 balance brought down 1 lakhs. How much is the closing balance? They have given 85,000. At the end of the year, 85,000 is the land and building. So calculate by balance brought down. On the credit side, leave 3 lines gap, record by balance carried down. Amount column record 85,000. Amount column record 85,000. So that is the opening balance and the closing balance. On the other hand, they have given additional information. A part of land was sold in 2016 and the profit was credited to capital reserve. See, any profit on sale of land and building, what will be the entry? When you are making profits, your profit and loss should be credited. So land and building account data to P&L account. That is how much is credited to capital reserve? 10,000. So land and building account data to P&L account. That is the profit entry. When there is a profit on sale of asset, you should take it to credit side of the P&L account. So land and building account data to P&L account. So here we are doing land and building account. So to P&L account should come now. So to instead of P&L account, they are crediting it to capital reserve. So to capital reserve, debit side record below the 2 balance to capital reserve. To capital reserve, how much is the profit made? 10,000. So amount column record 10,000. To capital reserve, amount column 10,000. So that is the only entry they have given. Now total it. 1 lakh minus 10,000, you are getting 1 lakh 10,000. and left hand side 1,10,000. That is debit side total it 1,10,000. Bring it to the credit side. Credit side also total it 1,10,000. 1,10,000. What is the closing balance? 85,000. So remaining balance is nothing but sales value. That is sale value of land and building. So 1,10,000 minus 85,000. Below that credit side record by bank. Below that particular record by bank within bracket balancing figure. It is nothing but by bank. By bank is nothing but cash is coming in. So by bank, when cash is coming in, what it does mean? Land and buildings, sales value of land and building. So within bracket balancing figure, amount column record 25,000. Amount column record 25,000. So total value of sales of land and building is 25,000. Out of that, 10,000 is the profit element. Remaining 15,000 is nothing but cost element. So 25,000. So see, by bank account, which means cash is fund is coming in. Okay, there is some increase in asset. So when there is cash coming in, what is the entry? It will go to the source of funds. When there is cash coming in or fund coming in, then it is source of fund. When there is fund going out, it is application of fund. So this land and building, that is sale value of land and building, should be taken to source of funds because there is some fund coming in. So come to the fund flow statement. Below the source of funds record sale of land and building. Sale of land and building. How much is the amount? 25,000 we calculated. So amount column record 25,000. By bank we calculated 25,000 in land and building. So that is what cash amount coming in. So that is nothing but incoming of funds. So sale of land and building is the source of fund. So amount column record 25,000. With that we have completed land and building. So moving on to the next point, that is machine they have given. So plant and machinery account. So below that working note number 3. Working note number 3. Plant and machinery account. Put the heading plant and machinery account. Divide the page into 2 parts. The left hand side debit, right hand side credit. Debit and credit. Debit column, debit side record particulars amount. Credit side also particulars amount. Debit side particulars amount, credit side also particulars and amount. See, plant and machinery, man. Plant and machinery is also an asset. So opening balance will come on the debit side and closing balance will come on the credit side. So record first opening and closing balance, just record it. Opening balance is 40,000. So to balance debit side, below the particulars record to balance 40,000 on the amount column 40,000. So closing balance is 1 lakh. Closing balance, that is plant and machinery closing balance is 1 lakh. So below that particulars, leave 3 lines gap, record by balance. Credit side record by balance, amount column 1 lakh. Amount column 1 lakh. So opening balance is 40,000, closing balance is 1 lakh. That we have found. What they have given, a machine has been sold for 5,000 rupees. So when there is sales value of machine for 5,000 rupees, how much of the cash is coming in? 5,000 by bank. So what is the entry? Bank account data to plant and machinery account. Plant and machinery should be credited because there is sale of plant and machinery. So how much cash is coming in? 5,000. So below that particular credit side record, by bank account amount column 5,000. By bank amount column 5,000. One more point they have given, written down value of machinery was 6,000. So 6,000 worth machinery was sold for 5,000. So you are making loss of 1,000. So when you are making loss of 1,000, what will be the entry? P&L account should be debited because whatever the loss you will be debiting P&L account, whatever the profit you will be crediting P&L account. So what is the entry for this loss? P&L account data to plant and machinery account. So in plant and machinery, P&L should be credited. So by P&L, below that by bank record by P&L 1,000. By P&L amount column record 1,000 rupees. So simple, understand this. Just remember the P&L account. When there is loss, you will put it on the debit side. When there is profit, you will put it on the credit side in the ledger account. So here it is loss. So you will be putting on the debit side of the P&L account. So in P&L account, you are putting debit side. So in the plant and machinery account, you should put credit side. So by P&L 1,000. Next, depreciation of 5,000 charged on plant is 2016. Depreciation of 5,000 was charged on plant. So for entire plant and machinery for 2015-16, depreciation was 5,000. What is the entry for depreciation? Depreciation account data to P&L account. Sorry, plant and machinery account. So plant and machinery will be credited, depreciation will be debited. So in plant and machinery account, credit side record by depreciation. Because depreciation is bringing down the plant and machinery value. So when there is decrease in plant and machinery value, plant and machinery will be credited. When there is increase in plant and machinery value, simple, remember this. When there is purchase of plant and machinery, what is the entry? Plant and machinery account debit to bank account. So when plant and machinery is increasing, it should be debited. So on the other side, when you are selling plant and machinery, what will be the entry? Bank account debit to plant and machinery. So when plant and machinery value is getting decreased, it should be credited. Same way during depreciation, that is for depreciation, plant and machinery value is getting decreased. So P&L account debit to depreciation account. So sorry, plant and machinery account debit to depreciation. You can put both the ways. P&L to depreciation also you can put, or plant and machinery to depreciation also you can put. Ultimately, it is going to get reduced from the plant and machinery. So to by depreciation, 5,000. Depreciation account debit to plant and machinery account. Again, this depreciation will go to P&L account. So P&L account debit to depreciation account. From plant and machinery, it will be reduced. P&L account, it will be debited. So by depreciation, amount column 5,000. Now, credit side total it. Credit side, we have entered all the values. Credit side total it. 5,000 plus 1,000 plus 5,000 plus 1 lakh, you are getting 1,11,000. 1,11,000. Credit side total it. Below that, underline it and record 1,11,000. In respect of that 1,11,000, debit side also total it. Bring that to the debit side. Debit side also total it 1,11,000. So out of this 1,11,000, opening balance is 40,000. Remaining entire balance has been purchased in the current year. When you are purchasing something, what is the entry? When you are purchasing plant and machinery, what is the entry? Plant and machinery account debit to bank account, because cash is going out. So now calculate to bank account. Below the to balance, record to bank account within bracket balancing figure. To bank account within bracket balancing figure. How much is the value? 1,11,000 minus 40,000. You are getting 71,000. So in respect of amount column, record 71,000, which is nothing but cash is going out. That is, fund is going out. Total fund amount of 71,000 is going out, and total fund amount of 5,000 is coming in. Both the things you should record in fund flow statement. So total purchase of plant and machinery is 71,000. How did we calculate? By calculating balancing figure, we calculated 71,000 is the total purchase of plant and machinery, and sale value of plant and machinery is 5,000. So moving to the fund flow statement, record in respect of source of funds, sale of plant and machinery. Sale of plant and machinery. Amount column, how much is the sale value? 5,000. Amount column, record 5,000. Amount column, record 5,000. On the application of funds, record purchase of plant and machinery. There is also purchase of plant and machinery. So record purchase of plant and machinery. For how much you are purchasing? 71,000. Amount column, record 71,000. Amount column, record 71,000. So that is plant and machinery account. Below that, working note number 4. Below that, working note number 4. So what is the next entry they have given? Interim dividend. So we should calculate what is the proposed dividend account, so that we can add interim dividend to the proposed dividend. We will get what is the total dividend paid during the year. Below that, working note number 4. Working note number 4. Proposed dividend account. Proposed dividend account. Divide the page into two parts. Debit side, left hand side debit and right hand side credit. Debit side, record particulars amount. Credit side also record particulars amount. Debit side, record particulars amount. Credit side also record particulars amount. Below that, see, dividend. Dividend is a liability. So opening balance will come on the credit side and closing balance will come on the debit side. So here opening balance is 21,000. So below that, credit side, record by balance. Normally for liabilities, opening balance will be on the credit side, closing balance will be on the debit side. Whereas for assets, opening balance will be on the debit side, closing balance will be on the credit side. So proposed dividend is a liability here. So opening balance will be on the credit side. So by balance, below that particular record by balance 21,000. 21,000. How much is the closing balance? 25,000. So below that, debit side, leave 3 lines gap, record to balance. To balance. How much is the closing balance? 25,000. So to balance 25,000. 25,000. Now see, previous year closing day, whatever the proposed dividend, that will be paid in the current year. We have seen this in the cash flow statement itself. We have seen this particular adjustment, that is proposed dividend of the previous year will be paid in the current year, and current year proposed dividend will be paid in the next year. So previous year proposed dividend is 21,000. So that 21,000 should be paid in the current year, and also an interim dividend of 10,000 has been paid in 2016. So 21,000 plus 10,000, total of 31,000 is paid in the current year. So when dividend is paid, what is the entry? Dividend account, proposed dividend to bank account, because cash is going out. So in respect of debit column, record to bank account within bracket 21,000 plus 10,000. Understand it. Why this 21,000 came is previous year proposed dividend is paid in the current year, and current year proposed dividend will be paid in the next year. So previous year proposed dividend is 21,000 plus interim dividend of 10,000. So total 31,000. So open a bracket 21,000 plus 10,000. Amount column recorded 31,000. Amount column recorded 31,000. Now total it. Debit side total it. 31,000 plus 25,000. Debit side total it 56,000. You are getting 56,000. Bring the total to the credit side. Credit side also total it 56,000. Credit side also total it 56,000. 56,000. So with that we have calculated what is the total. From that, if you take off opening balance, you will get what is the total proposed dividend that has been taken from the P&L account. That is total dividend that has been debited to P&L account. We'll get what is the value of dividend that has been debited to P&L account. So calculate it. Balancing figure is nothing but the amount which has been debited to P&L account. When you are debiting the P&L, you are going to credit the proposed dividend. So credit side record by P&L account. Below that by balance record by P&L account within bracket balancing figure. So this is the amount that has been debited to P&L account. So balancing figure, calculate the balancing figure. 56,000 minus 21,000, you are getting 35,000. So 35,000 is the amount which has been debited to P&L account. That is amount which has been reduced from the profits as proposed dividend. Okay. Now we are pretty sure that the bank account, that is proposed dividend paid during the year, is 31,000. So when you are paying proposed dividend, that is when you are paying dividend, what is happening? Cash is going out, that is fund is going out, which is nothing but application of funds. So come to the fund flow statement, record payment. Below that purchase of plant and machinery, record payment of dividend within bracket working note number 4. Working note number 4, amount column record 31,000. Amount column record 31,000. So that is application of funds. So now we have done for 3 adjustments. The last adjustment, that is an amount of 1,000 rupees has been received as dividend on investment in 2016. So you are receiving 1,000 rupees as dividend. When you are receiving dividend, what is happening? There is some incoming of funds. So it should be taken to the source of funds. So in respect of sources of funds, record below that sale of plant and machinery, record dividend on investment received. Dividend on investment received. Dividend on investment received. Amount column record 1,000 rupees. Below the sources of funds, dividend on amount investment received. Amount column record 1,000 rupees. 1,000 rupees. So that is the different adjustment they have given. Now go one by calculate see one by one. What are all the increase or decrease in liabilities? That is non-current liabilities and non-current assets. See. First we will start from the liability side. Equity share capital. Equity share capital, previous year ending 150, current year ending 200. So 50 rupees, that is 50,000 rupees increase in equity share capital. When there is 50,000 rupees increase in equity share capital, funds are coming in. You are issuing equity share capital, you are receiving cash. So funds are coming in. When funds are coming in, what is the entry? It should be taken to the source of funds because cash is coming in. So below the source of funds, record issue of equity share capital. Issue of equity share capital 200 minus 150, within bracket 200 minus 150. 200 minus 150. Amount column record 50,000. Under source of funds, issue of equity share capital, amount column record 50,000. Below that 9% redemption of preference shares. So preference share capital is previous year ending is 75, current year ending is only 50. So balance of 25 has been redeemed. So when you are redeeming preference shares, what is happening? Fund is going out. That is, you are applying your funds and you are getting back your certificates. That is preference share capital certificates. So 75 minus 50, that is 25,000 is redemption value of preference shares. So that redemption value should be taken to the application of funds because you are using your funds and getting back, you are buying back your preference share capital. So below that, redemption of preference shares within bracket 75,000 in respect of application of funds, redemption of preference shares, within bracket 75 minus 50, 75 minus 50, you are getting amount column record 25,000. Amount column record 25,000. So below that, capital reserve, general reserve, P&L account, all this will be taken care in the what is that, funds from operation account, which we should calculate, yet that working note is remaining. So next is proposed dividend, we calculated, sundry creditors we calculated, bills payable, liabilities for expenses, provision for tax, all these are we calculated. Then goodwill, see whether there is increase or decrease in goodwill will be taken to the funds from operation. Next, land and building we calculated, plant and machinery we calculated, investments. See, previous year ending investments is 10,000, current year ending investments is 15,000. So there is 5,000 increase in investments. When there is increase in investments, it is nothing but you are purchasing investments. When you are purchasing investments, you are using your funds. So utilization of funds, which is nothing but application of funds. You are applying your funds of 5,000 rupees and purchasing investments. So application of funds record. Below that application of funds record, purchase of investments. Purchase of investments within bracket 15 minus 10. Purchase of investments within bracket 15 minus 10. Amount column record 5,000. Amount column record 5,000. So see, next one, sundry debtors taken into account, stock, bills receivable, cash in hand, cash at bank, preliminary expenses will, there is decrease in preliminary expenses which will go to the funds from operation account. So with that we have calculated what are all the different non-current liabilities and non-current assets. So we have done with increase in working capital, purchase of plant and machinery, redemption of preference shares, payment of dividend and purchase of investments. All 5 application of funds done. On the sources of funds we have done sale of land and building, sale of plant and machinery, issue of equity share capital, dividend on investment received. So only one last value that is remaining to calculate is funds from operation. Just understand this funds from operation clearly. It is similar to profit and loss appropriation account. So below that, working note number 4, record working note number 5. Working note number 5, calculation of funds from operation. Working note number 5, calculation of funds from operation. Below that, divide the page into 2 parts. Divide the page into 2 parts. Left hand side debit and right hand side credit. Left hand side debit and right hand side credit. So this is the profit and loss. Debit side record particulars amount, credit side also record particulars amount. Debit side particulars amount, credit side also particulars amount. See, profit and loss, so that is funds from operation is nothing but profit and loss account, that is profit and loss adjustment account. Okay, so this profit and loss balances should be taken to the opening balance, should be taken to the credit side, and closing balance should be taken to the debit side. So this calculation of funds from operation, next to that funds from operation, just record P&L adjustment account. Within bracket record P&L adjustment account. Calculation of funds from operation within bracket P&L adjustment account. Below that, to divide the page into 2 parts, debit side and credit side. Debit side particulars amount and credit side also particulars amount. So now profit and loss account, what is the opening balance? 15,000. So this is liability. So opening balance will come on the credit side. So by balance, record under this P&L adjustment account on the credit side, that is below that particulars, record by balance. How much is the opening balance? Opening balance is 15,000. So record 15,000 amount column. Credit side by balance 15,000. 15,000. So that is one point. Next is closing balance, we know 24,000. So below that, leave 6 lines gap for under this debit side. Debit side leave 6 lines gap. Record 2 balance. Record debit side leave 6 lines gap. Record 2 balance. How much is the closing balance for profit and loss account? 24,000. So 2 balance 24,000. So that is the opening balance and closing balance of P&L account. That is profit and loss adjustment account. So next is, see one by one, what are the different entries which should be taken to the P&L account? All should be recorded in this P&L adjustment account, so that you will get what is the funds from operation. That is nothing but you will get what is the profit made by the business. So below that, we have actually in P&L adjustment account, we have considered what is opening balance, what is closing balance. Next is, see, come from the liability side. See, 9% done, 9% preference share capital done, capital reserve, it is entirely from the land and building, so don't consider it. So we have sold land and building, we got that capital asset, that is capital reserve. So it is not taken to the P&L account. So capital reserve done. It has been directly taken from the land and building profit and debited and credited in the capital reserve. It has not been taken from the P&L account. Whereas this general reserve, there is 20,000 in the previous year ending and 25,000 current year ending. The addition of 5,000 rupees, that is current year, P&L account has transferred 5,000 rupees to general reserve. But where capital reserve, this 10,000 rupees is transferred by land and building account. The profits from the land and building has been taken to the capital reserve, whereas amount from the P&L account has been transferred to general reserve. So you are transferring some amount from the P&L account. So it is nothing but it is reduction in P&L account. So record as there is increase in general reserve, below that record to general reserve. So you are taking from the P&L account and giving it to the general reserve. So there is reduction of value in P&L account. So it should be debited. When there is reduction value, it should be credited. That is when there is decrease in value in P&L account. That is when your profits are decreased, you should debit it. When there is increase in profit, that is when there is income, you should credit it. That is the P&L account format. So here you are transferring a part of P&L account value to the general reserve. So you should reduce it from the P&L account. So to general reserve, debit side to general reserve within bracket 25 minus 20. 25 minus 20, you are getting 5,000. Amount column record 5,000. So that is general reserve. So next is proposed dividend. See, you are paying something out of today. Like proposed dividend, you are paying 21,000 today. That is this year. Whereas from profit and loss account, we have transferred a value which has been calculated in the proposed dividend account. See, opening balance is 21,000, closing balance 25,000. Current year you paid 31,000. So remaining amount has been transferred from P&L account. How much is transferred from P&L account? 35,000. So bring that to the P&L account adjustment account. P&L adjustment account to proposed dividend. To proposed dividend within bracket working note number 4. To proposed dividend within bracket working note number 4. How much is the amount transferred to P&L account? 35,000. So from P&L account to proposed dividend, you are transferring 35,000. So record in respect of that proposed dividend, debit side record amount column 35,000. 35,000. So what is the next entry? Sundry creditors done, bills payable done, liabilities for expenses done, provision for tax is also done. So next, see goodwill. Goodwill, there is some decrease in value. So when there is decrease in goodwill, you are writing off goodwill. When you are writing off goodwill, your profit is coming down. Simple. It's like writing off your asset. Writing off your goodwill is like writing off your asset. There is 10,000 goodwill which has been sold for 0 rupees. 10,000 goodwill which has been written off for 0 rupees. So there is loss of 10,000. So below that to proposed dividend record to goodwill written off. When there is decrease in goodwill, debit side record it. When there is increase in goodwill, record it on the credit side. So to goodwill written off, amount column record 10,000. How did we calculate the 10,000? 50,000 minus 40,000. So to goodwill written off, amount column record 10,000. Amount column record 10,000. Next, land and building. Check the land and building account if there is any profit and loss entry. So there is no profit and loss entry. Next is plant and machinery account. Check plant and machinery account if there is any profit and loss entry. Yeah, there is P&L account of 1,000 rupees. P&L account has been debited and plant and machinery has been credited. So come to the P&L account debit side to plant and machinery account. To plant and machinery account within bracket working note number 3. Within bracket working note number 3, this amount column record 1,000. Amount column record 1,000. Debit side to plant and machinery account within bracket working note number 3. Amount column record 1,000. So this 1,000 is nothing but there is a machine has been sold for 5,000. Return on value 6,000. So there is loss of 1,000. So loss should be debited to the P&L account. So you are debiting the P&L account. So to P&L plant and machinery account 1,000 rupees. So that is one point. Next is again in plant and machinery there is depreciation which you are calculating. For land and building there is no depreciation. So whereas but plant and machinery they itself have given 5,000 rupees has been depreciated. So depreciation, what is the entry? Normally depreciation entry is depreciation to P&L plant and machinery account, then P&L account data to depreciation account. So here depreciation is 5,000 rupees which has been credited to plant and machinery. So depreciation to plant and machinery. Next entry is P&L account data to depreciation. So depreciation should be credited and P&L account data should be P&L account should be debited. So to depreciation on plant and machinery, Below that debit side record to depreciation on plant and machinery. Depreciation you will always deduct it from P&L account. You know that calculation. Depreciation you should deduct it from P&L account. That is the procedure of P&L account, profit and loss account. So to depreciation on plant and machinery, amount column record 5,000 rupees. Amount column record 5,000 rupees. So that is the depreciation amount. So next is investments. There is no changes in investments. There is purchase of investments which has been recorded in application of funds. Next is sundry debtors, stock, bills receivable, cash in hand, cash at bank. All are done preliminary expenses. Coming to the preliminary expenses, there is 8 rupees at the beginning of the year, 5 rupees at the end of the year. So you have repaid preliminary expenses of 3 rupees during the year. So when you are paying 3 rupees, that is equal to out of profits you are taking and giving 3 rupees. That is nothing but loss. So to preliminary expenses, debit side record, debit side below that record, to preliminary expenses, because preliminary expenses coming down, you have settled it using the profit. So 8 minus 5 remaining 3,000 is debited to P&L account. So to preliminary expenses within bracket 8,000 minus 5,000, within bracket 8,000 minus 5,000, record amount column 3,000, record amount column 3,000. So now debit side total it, debit side total it, just debit side you just total it, 5,000 plus 35,000 plus 10,000 plus 1,000 plus 5,000 plus 3,000 plus 24,000 closing balance. You are getting 83,000. You are getting 83,000. Debit side total it 83,000 and bring that to the credit side. So profit and loss adjustment account, debit side total is 83,000. Credit side also total it 83,000. So total is 83,000 and just deduct it from the balances. You will get what is the balancing figure. That is nothing but loss from fund from operation. That is, it is coming on the credit side. So funds from operation, there is some loss. There is some loss from operations. That is nothing but credit side balance of the funds from operation. So 83,000 minus 15,000 minus 1,000, you are getting 67,000. So record by funds from operation, credit side record by funds from operation, that is FFO, by funds from operation within bracket balancing figure, within bracket balancing figure, amount column record 67,000, which is nothing but loss. There is some 67,000 rupees which has been taken out of the funds. So it should be taken to the application of funds. By funds from operation balancing figure 67,000. So bring that to the funds from operation. See, understand it. I have told reciprocally, sorry. When there is amount on the credit side, that is by funds from operation, then it is the amount which has been received from the operations. Okay, you are making some profit of 67,000. So if it is coming on the debit side, you should take it to the application of funds. Whereas if it is on the credit side, you should take it to the source of funds. So here from the operations, you are receiving 67,000, which is incoming of funds. So the incoming of funds should be taken to the source of funds. So when there is credit side balance of funds from operations, then you should take it to the source of funds. When there is debit side balance, you should take it to the application of funds. So here funds from operation is on the credit side. So bring that to the source of funds. Below that issue of equity share capital record, funds from operations within bracket working note number 5. Within bracket working note number 5, amount column record 67,000. Amount column record 67,000. Now if you total it, both the sides should be the same answer, same amount. If it is not tallying, then you have made some mistake in the calculation. So now total it, 25,000 plus 5,000 plus 50,000 plus 1,000 plus 67,000. 50,000 plus 1,000 plus 67,000. You are getting 1,48,000. So source of funds total it, record 1,48,000. Now total the application of funds side. Application of funds 16,000 plus 71,000 plus 5,000 plus 25,000 plus 31,000. You are getting 1,48,000 on the application of funds side also. So application of funds also total it, record 1,48,000. So both are tallying. So that is the fund flow statement. That is fund flow statement. Simple, same logic you should continue for all the problems. First we should calculate what is statement of changes in working capital, then find increase or decrease in working capital, then bring that to the fund flow statement. If there is increase, application of funds. If there is decrease, source of funds. Then one by one calculate what are all the different non-current assets and non-current liabilities based on the adjustments they have given. First you finish off the adjustments, then come one by one. That is liabilities, one by one liabilities, then next one by one assets. First calculate what is the adjustment values, what are the adjustments they have given. For that calculated, you will get here they have given for land and building, plant and machinery, dividend and investment. Land and building, plant and machinery, dividend, investment directly. They have given 1000 rupees dividend on investment has been received. So take that to the source of funds. So then come one by one. Each column just each item just calculate it whether there is increase or decrease. So based on that, whether it is source of fund or application of fund, classify it and add it or divide it, minus it. Then come to the last working note, that is calculation of funds from operation. The funds from operation is nothing but P&L adjustment account. So record P&L adjustment account, debit side, credit side opening balance and debit side closing balance of profit and loss account. Then whatever is transferred to the reserve, just calculate it. Then go with one by one, that is what are all the different assets which has been written off, different liabilities. Then what is the depreciation, what is the loss on sale of machinery. When there is profit on sale of machinery, record it on the credit side. When there is loss on sale of machinery, record it on the debit side. That is here there has been loss on sale of plant and machinery 1000, so it is debited to the P&L account. So that way you calculate and calculate what is the funds from operation. If funds from operation is on the credit side, then take it to the source of funds because fund is coming in. If funds from operation is on the debit side, take it to the application of funds because funds has been taken out. So that is the problem number 1. This is how you should calculate fund flow statement. Again, problem number 2, similar kind of problem. Problem number 2, problem number 3, both are same. Same kind of problems. Okay, we'll solve problem number 2. This is December 2017 exam. December 2017 exam, they have asked in the inter paper 10. Paper number 10, that is FM. For FM, they have asked in December 2017. Okay. First we'll read the question. The balance sheet of A Limited as at the end of 2015 and 16 are given below. Okay. Liabilities and assets they have given for 2015, 16. Same different liabilities and different assets has been given. Next they have given adjustment. Just look into the adjustments. A plant purchased for 4,000, depreciation of 2,000 was sold for cash of 800 on September 30, 2015. So they are selling for 800, but worth of that written down value of that plant is 2,000. So 4,000 minus 2,000, you are getting 2,000 rupees. That is the written down value of that plant. Whereas you are selling for 800, remaining 1,200 is nothing but loss. So it should be taken to the P&L account. P&L account data to plant and machinery account. Next is on June 30, 2015, an item of furniture was purchased for 2,000. So there is purchase of furniture, which is nothing but application of funds. These were only transactions concerning fixed assets during 2015. Okay. The dividend of 22.5% on original shares was paid to equity shareholders. Here, original shares is 1,50,000, whereas dividend at the rate of 22.5 on original shares has been paid as dividend. On original shares, 22.5% has been paid as dividend. So we should take it down. Dividend, that is nothing but proposed dividend. Here they have not given any proposed dividend, so only we should take directly debited to the P&L account and the funds from operation fund flow statement. In fund flow statement, in obligation of funds, we should directly put dividend paid 22.5% of equity share capital. So below that, you are required to prepare fund flow statement and verify the results by preparing schedules of changes in working capital. Both the account we should prepare. So moving on to problem number 2, same sums, same concept. Actually, fund flow statement, it is very rare to in exam. If they ask also, they'll ask easy sums. Like this problem number 2 only they'll ask. There is nothing to confuse in this problem number 2. Only if you on yourself getting confused, you will lose the marks in this particular chapter, or else you can easily score the entire marks from this chapter. So problem number 2, below that record, next problem, that is problem number 2 and statement number 1. Statement 1, fund flow statement of A Limited for the year ended 31st March 2016. Fund flow statement of A Limited for the year ended 31st March 2016. Below that, divide the page into two parts. Left hand side, sources of funds and amount. Left hand side, source of funds and amount. Right hand side, application of funds, amount. Source of funds and amount, application of funds and amount. So that is the format of fund flow statement. So below that leave 10 lines gap. Below that leave 10 lines gap. Now start off your working notes. Same procedure. Working note number 1. Leave 10 lines gap. Record working note number 1. Statement showing changes in working capital. Statement showing changes in working capital. Below that, 3 column table. First column particulars, second column 2014-15, and third column 2015-16. Third column 2015-16. Particulars 2014-15 and last column 15-16. So below that particulars, first, what is the format of working capital? Current assets minus current liabilities. First record capital A. Below that particulars, record capital A, current assets. Current assets. Below that current assets, record one by one. What are all the different current assets they have given in this question? Investment is considered as long-term investment, so don't bring it to the current assets. So debtors, stock and cash are 3 different current assets. So record below that current assets, debtors 14-15 column record 30,000 and 15-16 column record 70,000. 15-16 column record 70,000. Next, below that stock 14-15 column record 60,000. 15-16 column record 65,000. 60,000 and 65,000. Then cash 2015 column 30,000. 14-15 column 30,000. 15-16 column 45,000. So cash is, in respect of cash, record 30,000 and 45,000. Now that is the current assets. Now current assets total it. 14-15 column first total 30,000 plus 60,000 plus 30,000. You are getting 1,20,000. So in respect of that 14-15, below that underline it, record 1,20,000. For 2015-16 also total it 70,000 plus 65,000 plus 45,000. You are getting 1,80,000. So below that underline it, record total 1,80,000. So in respect of that 1,20,000 and 1,80,000, record total. So that is the total of current assets. Below that small capital B, current liabilities. What are the different current liabilities they have given in the problem? See, provision for depreciation on plant and machinery. That is also a depreciation account. This is also depreciation. That is not a current liability. Provision for taxation is a current liability. Sundry creditors is current liability. So two items are current liabilities. Below that current liabilities, record provision for taxation. 2015-16 column record 20,000. Sorry, 2014-15 column record 20,000 and 2015-16 column record 30,000. Record 14-15 20,000 and 15-16 30,000. And sundry creditors column 14-15 column record 86,000. 15-16 column record 95,000. 86,000, 14-15 and 15-16 95,000. 15-16 95,000. So now current liabilities column total it. For 14-15, how much is the total? 20,000 plus 86,000. You are getting 1,06,000. Total it 1,06,000. And current liabilities 2015-16 also total it 80,000 plus 30,000 plus 95,000. 30,000 plus 95,000. You are getting 1,25,000. So total it 2014-15 current liabilities 1,25,000. So in respect of that, record total. Below that capital C, net working capital. Within bracket capital A minus capital B. Within bracket capital A minus capital B. So what is the net working capital? current assets minus current liabilities. 1,20,000 minus 1 lakh, you're getting 1,06,000, you're getting 14,000. 1,20,000 minus 1,06,000, you're getting 14,000. So in respect of 14, 15 column record 14,000, and in respect of 15, 16 column record 1,80,000 minus 1,25,000, you're getting 55,000. You're getting 55,000. So that is the net working capital. So 14, 15, it is net working capital. Working capital is 14,000. 15, 16, working capital is 55,000. So there is increase in working capital. So extra funds has been applied for working capital. So it should be taken to the working application of funds account, application of funds side. So below that, increase in working capital is equal to 55,000 minus 14,000. 55,000 minus 14,000, which is equal to 41,000. So bring that amount, increase in working capital, to the application of funds side. Below that application of funds, record increase in working capital. Within bracket working note number 1. Amount column record 41,000. Now increase in working capital is 41,000. Below that, see, we have finished what is working capital. Then what we should do, then one by one, using the adjustments, we should do the different non-current liabilities and non-current assets account. So first, what they have given, plant. So open a plant account. Moving on to working note number 2. Record calculation of, see here one more thing, they have given plant at cost, furniture at cost, whereas they have separately calculated in the liability side. They have opened a different, a separate account, that is provision for depreciation on plant, provision for depreciation on furniture. So they have opened separate account. So what we can do here is, we can sum up this depreciation into one account, and we can find what is the current year depreciation, which should be reduced from both the depreciation account. So the current year depreciation, total depreciation, will be taken to the P&L adjustment account, which is defined by funds from operation account. So below that, working note number 2, calculation of total depreciation for current year. Below the 3 columnar table, this is one easy way of calculating what is the total depreciation. That is, what is the opening depreciation, from that take off all the depreciation for which asset has been sold, then remaining deduct it from the closing depreciation, you will get what is the current year depreciation. So 3 columnar table, first column particulars, second column amount, and third column also amount, particulars, amount, and amount. Below that, particulars capital A. First we will calculate on plant, then we will calculate on furniture. So on plant depreciation they didn't give, on furniture also depreciation they didn't mention directly, whereas there is some difference in total. So using that, we can easily find what is the current year depreciation. First, capital A on plant. Below that, first small Roman number 1. Below that, small Roman number 1, opening provision for depreciation. On plant, how much is the opening provision for depreciation? 50,000. So record inner amount column, record 50,000. So on that 50,000, how much is in respect of plant sold depreciation? Plant purchased for 4,000, on respect of which depreciation is 2,000 was sold. So sold, that is, on the plant and machinery which has been sold, depreciation is 2,000. So you should take it off from the provision for depreciation. Below the statement number, small Roman number 2, less depreciation relatable to plant. Sold. In respect of amount column, within bracket record 2,000. So in amount column, inner amount column, total it 50,000 minus 2,000, you are getting 48,000. So 48,000 is the opening provision minus depreciation relatable to plant sold, 48,000. What is the closing depreciation? They have given 56,000. So the remaining balance is nothing but, the difference is nothing but current year depreciation. So below that, statement number 3, Small Roman number 3. Small Roman number 3. Closing provision for depreciation. Record closing provision for depreciation. What is the closing provision for depreciation on plant? 56,000. Opening is 50, closing is 56. So closing provision for depreciation in the inner amount column record 56,000. Inner amount column record 56,000. So now below that, small Roman number 4, current year depreciation. Current year depreciation. Within bracket record 56,000 is the closing provision for depreciation, and adjusted opening provision is nothing but 48,000. We have to take off this 2,000 because it is in respect of plant sold. So 56,000 minus 48,000. 56,000 minus 48,000, you are getting outer amount column record 8,000. Outer amount column record 8,000. So current year depreciation amount, outer amount column record 8,000. So that is the current year depreciation relatable to plant. Below that capital B on furniture. Capital B on furniture. See here, current year they didn't tell any amount, any plant which has been sold. So if it has been sold, then only we can find what is the profit or loss. And depreciation related to that should be taken off from the provision for furniture. Whereas here only purchase has happened. So the difference between opening balance and closing balance of provision for depreciation on furniture is nothing but current year depreciation. So below that, capital B on furniture, depreciation on furniture, within bracket 6,000 minus 5,000, that is closing balance minus opening balance. Within bracket 6,000 minus 5,000, outer amount column record 1,000. Outer amount column record 1,000. So now outer amount column just total it. Outer amount column total it 8,000 plus 1,000. 8,000 plus 1,000, you are getting outer amount column 9,000 rupees. Outer amount column 9,000 rupees. 8,000 plus 1,000, outer amount column 9,000 rupees. So that is nothing but total depreciation for current year. Okay, done. See, this is the total depreciation for current year. It should be taken to the funds from operation statement. That is, by calculating profit and loss adjustment account, this should be debited to the P&L adjustment account. Done. Now, here they have given assets, so that has been taken into consideration. Depreciation done. So both this liabilities account done. Now moving on to the asset side, that is plant, furniture, free land, freehold land. Here asset side, first freehold land. First we will finish off what are the adjustments they have given. Here for plant they have given adjustment, so we'll record plant account. So below that, working note number 3. Working note number 3, plant account. Plant account. Divide the page into 2 parts. Divide the page into 2 parts. Left hand side debit and right hand side credit. Debit and credit. Debit side record particular amount. Credit side also record particular amount. Debit side particular amount. Credit side also particular amount. See, plant account. Plant account is a asset account. So asset account, you will always record opening balance on the debit side and closing balance on the credit side. So record opening balance, how much it is? 1,04,000. So debit side record 2 balance 1,04,000. And closing balance is 1 lakh. So on the credit side record buy balance 1 lakh. 1 lakh. So opening balance is 1,04,000, closing balance is 1 lakh. And see, a plant purchased for 4,000. So the original cost of plant is 4,000. Depreciation is 2,000. This depreciation we take off. We have taken that from. We have removed that from the provision for depreciation account. Whereas this remaining 4,000, that is original cost of 4,000, should be removed from the plant account. So by asset for disposal, total cost of 4,000 you should remove it. By asset for disposal, amount column record how much is the asset which has been disposed of. A plant purchased for 4,000. So original cost is 4,000. So by asset for disposal 4,000. Credit side record by asset for disposal 4,000 rupees. Amount column record 4,000. So if you total it, it is 1,04,000. So there is no additional purchase of plant. Only there has been 4,000 rupees worth plant which has been sold. So amount column total it. Debit side total it 1,04,000. Credit side also total it 1,04,000. Debit side also 1,04,000. Credit side also 1,04,000. Simple. When a separate accounts for depreciation and plant has been made, that is, plant will be valued at cost itself, whereas on the liability side separate depreciation account has been done. That at that point you should calculate what is the depreciation that should be removed from the provision for depreciation, which is relatable to asset which is being disposed. That you should remove, and also the cost which is relatable to asset which is being disposed, that you should remove from the plant. Both the values which has been removed should be debited to the asset for disposal account. When you are crediting the asset for disposal account, then you will get what is the total value of profit or loss which has been made from by selling the asset. So here the depreciation has been removed from the P&L account, sorry, provision for depreciation account, and the cost has been removed from the plant account, that is by asset for disposal. So plant account by asset for disposal cost we have removed 4,000. So below that, working note number 4, put that in asset for disposal account. You are opening a separate account for asset for disposal. So asset for disposal account, divide the page into 2 parts. With this account you can clearly understand what is the asset for disposal, why we are doing it in that way. So asset for disposal account, divide the page into 2 parts. Left hand side debit and right hand side credit. Debit and credit. Debit column record particulars amount, credit column also record particulars amount. So see carefully, when provision for depreciation account has been deducted with depreciation relatable to plant, that is depreciation which is relatable to plant has been reduced from the provision for depreciation account. Normally provision for depreciation account is a liability account. Opening balance will be on the credit side, closing balance will be on the debit side. So when you are reducing the provision for depreciation account, your asset for disposal will be debited. Okay, asset for disposal will be debited, whereas the entry for removing the provision for depreciation, the journal entry is nothing but asset for disposal, that is provision for depreciation account data to asset for disposal. So asset for disposal will be debited, provision for depreciation will be credited. So when your provision for depreciation is credited, asset for disposal is debited. So asset for disposal by provision for depreciation. Okay, your asset for disposal account will be like when you are reducing your liability, normally in the liability account, that is in your provision for depreciation account, opening balance will be on the credit side, closing balance will be on the debit side. Okay, so you will put it on the debit side to asset for disposal account, so that your balance will come down. So to asset for disposal. In provision for depreciation, it is to asset for disposal. So in asset for disposal, it will be by provision for depreciation. So by provision for depreciation, under credit column record by provision for depreciation, how much is the depreciation which we removed? 2,000. So amount column record 2,000. So 2,000 is a depreciation in respect of that asset. So the asset total value is the you have credited to plant account by asset for disposal 4,000 rupees. So that you should debit in the plant asset for disposal account. To plant and machinery, debit side record to plant and machinery account, amount column 4,000 rupees. To plant and machinery, amount column 4,000 rupees. By provision for depreciation. So simple, understand this concept clearly. Asset for disposal, it is nothing but some you are calculating what is the profit or loss made by selling of that particular asset. So asset for disposal account, what is the cost of asset, that will come on the debit side. To P&L account 4,000. And what are the different cost reductions done to the plant and machinery, that is you are debiting your provision for depreciation every year. So this should be credited to asset for disposal account. So by provision for depreciation 2,000. Next, how much you are receiving? So provision for depreciation 4,000, you should remove 2,000. So remaining is the written down value. From that, if you remove the by bank, that is you are selling that asset and by getting cash. So when you are getting cash, what is the entry? Cash is coming in. So bank account data, when asset is going out, what is the entry? Asset for disposal. So bank account data to asset for disposal. So by bank, in respect of credit side, asset for disposal record by bank, how much you are receiving? You are receiving for cash of 800. So by bank account cash, by bank account amount column record 800. By bank account amount column 800. So now if you balance it, you will get what is the loss on sale of asset. So now asset debit side total at 4,000. Debit side total at 4,000. Bring it to the credit side 4,000. Bring it to the credit side 4,000. So cost of machinery is 4,000. From that depreciation take of 2,000. That is remaining 2,000 rupees is a return on value, and you sold it for 800. So remaining 1,200 is nothing but loss. When you are making loss, it will be on the asset. Your plant and machinery, sorry, your P&L account will be debited and your asset will be credited. Your asset account is credited with P&L account, that is by P&L 1200. If it is a profit, it will come on the debit side. If it is a loss, it will come on the credit side. So by P&L account, below that by bank account record, by P&L account, within bracket balancing figure. See, these are very normal calculations. Like you don't want me to explain all the single concept, why it is been debited, why it has been credited. We have studied in the like financial accounting also. Entire subject is on which are the entries should be debited, which are the entries should be credited. So when there is loss, P&L account will be debited. When there is profit, P&L account will be credited. It is like you have already done all those you know all those concepts. Whereas while solving this, you should remember all those concepts so that it will be helpful for you to do this fund flow statement. So by P&L, here there is loss on sale of asset. So when there is loss, your P&L account will be debited. When your P&L account is debited, your asset will be credited. Here you have bring your asset to the asset for disposal. That is, whichever the asset you are disposing, that will be the separate account will be created as asset for disposal. So when there is loss, your P&L account is debited, your asset should be credited. So in the asset for disposal, credited you are debiting, that is you are crediting by P&L account 1200. Within bracket balancing figure 1200. Normal concept, man. If there is loss, P&L account should be debited, asset account should be credited. That's all. Here you are doing by P&L account. So P&L account data to asset for disposal account. So that is the asset for disposal. Here we have found cash of 800 rupees is coming in. So that cash of 800 rupees coming in is nothing but source of funds. So by sale of plant, 1000 rupees is coming in. So come to the fund flow statement. Below the source of funds record sale of plant within bracket working note number 3, amount column 800. Within bracket working note number 3, amount column 800. See, next furniture. They have given on June 30, 2015 an item of furniture was purchased for 2000. So they are purchasing furniture. That is one point. Furniture, how much is the difference? Only 2000. So the difference of 2000 is nothing but purchase of furniture. If there is a difference of 5000 or 6000, or if there is decrease in furniture, then you should open a separate account and calculate what is the purchase or sale of furniture. Whereas here there is 2000 increase in furniture, and they have given in the entry 2000 furniture has been purchased. So the 2000 you should take it to the application of funds, because when you are purchasing furniture, you are investing your funds. That is, you are applying your funds. So below that application of funds record purchase of furniture. How much you are purchasing? 2000 rupees. So purchase of furniture, amount column record 2000. Amount column 2000. These were the only transaction concerning to fixed assets during 2015. Done. These are the different calculations regarding 2015 fixed assets. So next is, see, two things we are doing. One is the remaining adjustments we should take into consideration, and what are all the different changes in assets and liabilities we should take into consideration. Here dividend, they are given a dividend of 22.5 on original shares was paid to the equity shareholders. So 22.5 is nothing but, see, always remember this, equity dividend will be paid on the outstanding shares at the beginning of the year. Suppose this 50,000 there is increase in equity shares, so which is nothing but 50,000 rupees you are issuing cash by issuing equity share capital, but you are issuing this equity share capital during the year on which you won't pay equity dividend. So always this equity dividend should be calculated on original shares. Original shares is nothing but shares outstanding on the beginning of the year. That is original shares, and whatever has been issued, summation of all this equity shares outstanding at the end of the year. So original shares is nothing but equity shares outstanding at the beginning of the year. That is 1 lakh. So in respect of application of funds, below that purchase of furniture record payment of dividend 1 lakh into 22.5%. 1 lakh into, below that open a bracket, 1 lakh into 22.5%. Why did you take 1 lakh? Because they have given, underline it, original shares. Original shares means shares outstanding at the beginning of the year. So payment of dividend within bracket 1 lakh into 22.5%. Amount column record 22,500. Amount column record 22,500. So that is the payment of dividend. So with that we have done all the adjustments. So now we'll go one by one, liabilities and assets. See, share capital. Year opening is 1 lakh, ending is 1 lakh 50. So there is 50,000 increase in share capital. So which is nothing but source of funds, that is funds is been coming in, and also share premium. By issuing the shares, you have received share premium of 5,000. So total of 55,000 is the cash coming in. So below the sale of land record, source of funds below the sale of land record, issue of share capital within bracket 50,000 plus 5,000, 50,000 plus 5,000, which is nothing but 55,000. Amount column record 55,000. Amount column record 55,000. So that is issue of share capital. Then general reserve. Any increase in general reserve should be debited to P&L adjustment account. Next, profit and loss account. 6% debentures. See, understand it carefully. 6% debentures. Opening balance is 70,000. Okay. Closing balance is 50,000. So there is 20,000 reduction in 6% debentures, which means you have repaid. That is repayment of debentures of 20,000 rupees. When you are repaying, your cash is going out, your fund is going out. You are applying your funds and purchasing your 6% debentures back. That is 20,000 repaying. So when you are repaying, it is application of funds. So in respect of application of funds record, redemption of debentures, that is you are redeeming your debentures within bracket 70,000 minus 50,000. Within bracket 70,000 minus 50,000. Amount column record 20,000. Amount column record 20,000. Done. That is done. So next is provision for depreciation of land taken into account, depreciation of furniture done, provision for taxation done, sundry creditors done. Next, freehold land. See, freehold land for 2015 and 2016 are same. So there is no source of fund or application of fund from this freehold land. Next, planted cost. Planted cost 4,000 you have sold. So you have taken into consideration what is the sale value. Next, furniture 2,000 rupees, that also taken into consideration. Next, investments. Investments opening balance is 60,000, closing balance is 80,000. So remaining balance of 20,000 you are purchasing investments. When you are purchasing investments, you are applying your funds. So in respect of that application of funds record, purchase of investment within bracket 80,000 minus 60,000. 80,000 minus 60,000, you are getting 20,000. Amount column record 20,000. Amount column record 20,000. So that is purchase of investment. So next is data, stock and cash. All three are already taken into account. So this is the entire non-current liabilities and non-current assets, and current assets and current liabilities have been taken care in the working capital. So last one point which is left over is profit and loss account, which is funds from operation. So below that table itself record below that working notes record working note number 5. Working note number 5, funds from operation within bracket P&L adjustment account. Funds from working note number 5, funds from operation within bracket P&L adjustment account. Divide the page into two parts. Left hand side debit, right hand side credit. Debit side record particulars amount. Debit side record particulars amount. Credit side also record particulars amount. See, for P&L account is a liability. Opening balance will be taken to the credit side. Closing balance will be taken to the debit side. So opening balance is 10,000. So record opening balance. Credit side record buy balance. Credit side record buy balance 10,000. And leave 4 lines gap. Debit side record 2 balance. How much is the closing balance? 17,000. So debit side record 2 balance 17,000. 2 balance 17,000. So that is done. P&L adjustment account. So opening balance and closing balance we have taken into account. Next we should consider what are all the different profits and loss which should be taken to the profit and loss adjustment account. So depreciation should be taken to the profit and loss adjustment account, that is 9,000 rupees. Total depreciation is 9,000. So record to depreciation on the debit side, record to depreciation account within bracket working note number 2, to depreciation account working note number 2, 9,000 rupees. 9,000 rupees. So see, general reserve, go one by one. Share capital taken into account, share premium taken into account. General reserve 50,000 is the 2015, 60,000 2016. So 10,000 has been transferred to general reserve during the year. That 10,000 is been transferred from P&L account. When you are transferring from P&L account, your P&L account is going down. No. So record on the debit side to general reserve. You are transferring from general reserve, from P&L account to general reserve. So from P&L account, you should reduce the 10,000, and here in general reserve they added 10,000. So record to general reserve within bracket 60 minus 50. So amount column record 10,000. 60,000 minus 50,000. Amount column record 10,000. Amount column record 10,000. So that is general reserve that has been transferred to general reserve. Next, see, coming to the next working note, that is working note number 3, plant account. There is some loss on asset for disposal. So in the asset for disposal account, we have transferred to P&L account 1,200. So which is nothing but loss on sale of plant. So below that record to loss on sale of plant, or also you can record to asset for disposal. To asset for disposal within bracket working note number 3. To asset for disposal within bracket working note number 3, how much has been transferred from to P&L account 1,200. So debit side to asset for disposal, amount column record 1,200. Amount column record 1,200. So that is on the debit side. Next on the credit side, see, proposed dividend of 22,500. One second. See this proposed dividend, they have written it on the credit side. Erase it, like don't copy it. Below that itself, debit side below that, when you are paying dividend, how much you are paying, that should be debited to your P&L account, right? When you are paying dividend, that is out of profits. So below that record two proposed dividend. How much is the proposed dividend? We have calculated original shares 1 lakh into 22.5, that is 22,500. To proposed dividend, amount column record 22,500. 22,500. Now total the debit side 10,000 plus 9,000 plus 1,200 plus 22,500 plus 17,000 is the closing balance. You are getting 59,700. So debit side total it 59,700. Bring that to the credit side. Credit side also total it 59,700. 59,700. So now calculate the balancing figure. That is nothing but funds from operation. 59,700 minus opening balance of 10,000 minus, that's all. You are getting 49,700. So by funds from operation within bracket balancing figure, amount column record 49,700. Amount column record 49,700, which is nothing but the profit which you are receiving from operations. By funds from operation 49,700. This proposed dividend, it has been taken on the debit credit side. Erase, don't copy it from the notes. Just record what I am saying. The two proposed dividend 22,500. So just erase it. If you have written, just erase it. It is two proposed dividend. That is two dividend paid 22,500. So funds from operation is 49,700. So take it to the bring that to the fund flow statement. So funds from operation, when there is profit, when it is on the credit side, so it is a profit. So cash is coming in, which is nothing but fund is coming in. So source of funds. When there is incoming of funds, it is source of funds. So funds from operation, amount column record 49,700. Funds from operation, amount column record 49,700 within bracket working note number 4. Working note number 4. So amount column total it 800 plus 55,000 plus 49,700. You are getting 1,05,500. 1,05,500. Now application fund of funds also total it 41,000 plus 2,000 plus 20,000 plus 20,000 plus 22,500. You are getting 1,05,500. So source of funds is also 1,05,500. Application of funds is also 1,05,500. So that is the problem number 2.